Well, there's a major shift underway in private markets with high net worth investors increasingly driving inflows. But could that shift pose more risk than reward? Leslie Picker joins us now with more from the latest installment of CNBC's Inside Alts newsletter. Leslie, good morning.
Hey, good morning, Mike. That's right. In our latest edition of our Inside Alts newsletter, we dove into the so-called retail revolution taking place in alternatives right now. Traditionally, fundraising in areas like private equity and private credit has comprised institutional investors, things like pension funds or endowments, but there's been a huge and very fast shift toward retail, largely high net worth individuals. State Street says this cohort will drive more than half of private market fundraising over the next few years. But quick growth can also lead to risks. A new paper from Harvard found using, quote, suggestive evidence that there's a performance disadvantage among funds sold to retail. I asked Ares CEO Michael Arrighetti about this notion right after the firm announced that it was boosting its AUM targets based almost entirely on retail momentum.
I think the reason it's growing now is you have the highest quality, largest global managers bringing institutional quality and institutional adjacent product into this market in a way that they hadn't before. So this narrative of, weaker product being reserved for retail is just not true.
Of course, the next frontier is 401ks and the recent executive order that the Trump administration signed directing agencies to facilitate greater access to alternatives. To learn more about what Arrighetti thinks about that and much more, click on the QR code on your screen. Inside Alts working on with Robert Frank as well. Guys?
Leslie, great to see you. And this is a really terrific interview that you did with Ares. I'm curious, a lot of the growth recently for Ares has come from these semi-liquid funds. They launched a sports and media fund that I guess they're talking about doing quarterly redemptions or allowing that. Is there any sense from your look at the industry of how that liquidity, which these investors want, is going to affect returns in private equity going forward? Or has Ares seen any impact on returns in exchange for that liquidity?
Yeah, so the retail interest is largely comprised of these semi-liquid funds, whether it's Ares or elsewhere. A lot of that has to do with kind of a private credit or secondary, so it's not so much in the private equity space. But of course, if you do buy into one of these funds, it's definitely not as illiquid as a traditional private equity vehicle. It's not going to take 10 years to get your money back if you want to do so, but you can only redeem or ask for some distributions on a quarterly basis or annual, kind of depending on the structure there. So this is the type of thing that's spearheading this shift toward retail, this idea that, yes, you can be a little bit more liquid. Yes, that means you may see less volatility because you're not seeing kind of, second by second or millisecond by second ticks as you would in the public markets. But of course, as the Harvard paper points out, that also comes with some risks that may be masked as having limited volatility when in fact it's just less liquidity.